We're joined on the phone by Jim Sullivan, a managing director with Green Street Advisors, to discuss trends in REIT share prices versus the underlying properties of their portfolios. Jim, what kind of trends are we seeing right now?
The public market, that is REIT investors, are indicating an expectation that they think commercial real estate prices are headed higher, and that's an important reason why they're willing to pay a premium to the net asset value of the companies in our coverage universe. And what we're seeing, however, on the private side is a real stickiness to prices. Prices really aren't going up in the private market, and the lack of debt financing is a key reason why we're seeing that dispersion between what the public market is indicating and what the private market is indicating.
Do you think this creates any advantages for public companies?
It creates a cost of capital advantage that the private companies that don't have access to the unsecured market just can't compete with. And we're seeing the same thing on the equity side. The cost of equity in the public domain is much lower from the issuer standpoint than the cost of equity would be for a private entity going out and trying to do a traditional equity deal with an institutional investor. So the REITs now enjoy what, by our estimate, is an unprecedented cost of capital advantage over private entities.
So what does this all mean for REITs?
Well, the debate really is how much distress is there going to be in the commercial real estate environment, and what will that mean in terms of investment opportunities. And it's a very fair debate. I think there's no doubt that the commercial real estate industry will suffer a significant amount of distress, both on the operating front, but on the capital front as well. Where the debate really rests is what will that mean? What will well-capitalized buyers see in terms of investment opportunities? What will the quantity be? What will the discounts to fair market value be? And most importantly, when might those opportunities arise and arise in volume?
And what's your view of current debt-to-equity ratios among REITs?
The next phase is the industry still has too much leverage. Companies need to continue to delever. Selling assets is one way to do that, but at current share prices, issuing more equity is probably a more efficient way for most companies to achieve a deleveraging goal.
So do you think we'll see even more equity issuances?
We're a little bit surprised that we haven't seen more equity activity as the RMZ has pushed towards 600, and most companies in our coverage universe trade at premiums to NAV. It's our expectation that it's our hope that we'll see more in terms of common equity issuance at current prices, because we think that despite the advances the REIT industry has made in delevering its balance sheet, individual companies still have, in some cases, a long way to go on that front.
And what do you make of concerns regarding shareholder dilution?
The short-term impact on earnings and FFO is very unimportant to us. The impact on shareholder value, which is easily measured by net asset value and increases in net asset value, is really paramount. So I think the discussion gets a little bit fuzzy when you use the word dilution, because you really need to refine that and explain what sort of dilution are you worried about, and what sort of dilution should you be worried about as an investor.
Thanks, Jim. For more information on this and other REIT news and analysis, check out REIT.com.